Hello and welcome, relevant listeners, to Field Notes by Relevant, our new audio series. In this short audio series, the Relevant team shares honest, in-the-moment reflections from our everyday work, from supporting impact entrepreneurs on the ground to thinking through what it really takes to shift capital towards the purpose economy. Join us for conversations between the work as we reflect on what we're observing, learning and questioning while mobilizing capital into overlooked markets. My name is Elise, and today I am joined by Edson, our investment and operations lead. We will be talking about capital and capability and what it looks like behind the scenes when it comes to building businesses that last in Uganda. So, welcome Edson. To kick us off on this topic, you can tell us a little bit about the context. For example, in Uganda, many small and growing businesses struggle to grow beyond survival. From your experience, why doesn't access to capital alone automatically translate into impact?
Thank you for having me, Elise. So, business is difficult, and that is why we see some numbers and statistics showing that over 70% of businesses do not make it past their first 3 years of operation. So capital is an enabler. It's not an end in itself. And many entrepreneurs, unfortunately, see it as so. So in the process of building businesses, they focus on raising capital, writing proposals, and forget that the core of business is understanding the problem of your customer and coming up with solutions. And it never really should start with capital. And entrepreneurs that forget this and focus on raising capital move further and further away from serving their customers. And in a year, 2, or even 3, many of these businesses collapse. And the businesses that focus on understanding and delivering value for their customers as their primary objective, these businesses live a long time. So looking for capital and seeking capital alone is not enough. It's about understanding how to grow your business, understanding your customers, and building those foundations with or without capital.
Okay, so at the same time, so now you've talked a lot about how capital in itself isn't the means to an end. But the thing is, we see that at the same time, there's programs that have been implemented here in Uganda that offer training or coaching or exactly the insights that you just talked about now without the capital attached. So why doesn't business development on its own scale for small and growing businesses in Uganda?
It's critical to understand that businesses have a journey that they take. So the needs of a business at different stages are different. So in my perspective, you start out at the idea stage where you are trying to understand the problem, you're conceptualizing the solution. You then go on to the prototyping stage and building a minimum viable product, right? So at the stage of, building your MVP, you might need some capital. You can use available resources. We call it bootstrapping, to test the key assumptions for your business. What you need at the time is not, thousands of dollars, sometimes not even $1 in order to test it, right? You could test it with a simple website. You can put up one pager. At the early stage, it's all about talking to people. It's about understanding the problem. So you might not even need to use a shilling. But then as the business grows and you have verified the need for your services and you're starting to build products, you're looking for licenses, then some startup capital is needed. Many entrepreneurs at this stage start to look for seed funding, which could be critical in, moving past that stage. Some entrepreneurs are still able to bootstrap from that point on. And others, as the business grows even further, to growing locally, serving even more people, to scaling regionally and even internationally, then you see entrepreneurs utilize different forms of capital, from debt to equity to convertible notes and all these other instruments to grow their businesses. So I think for an entrepreneur, it's critical to know at what stage are you able to bootstrap or not, basing on the business that you are running. Is the business, producing sufficient revenue for you to reinvest that without need for capital? Capital comes at a cost. One thing entrepreneurs forget: you either give up equity or you give up interest. So it is critical to also raise funding if you need it.
Okay. So we've sort of talked now about both the perspective of what kind of support and what an entrepreneur needs to be thinking about without the money, and then what perspective they have when they need to think about how to get money and where to get it. So how do you think this dynamic of not thinking about both, right? So of the money without the support or the support without the money affect the development of entrepreneurs themselves, especially the shift from a grant or project mindset to an entrepreneurial one, something that we see a lot here in Uganda?
One thing I can emphasize is the reason why people start businesses. Businesses are started for two reasons: to solve a problem or to utilize and maximize an opportunity you have identified. So if you are trying to solve a problem, then the biggest focus should be on understanding it and solving that problem, and not looking for money or raising capital as an end in itself. So for many entrepreneurs, especially those that have had a taste of grant capital, many of them enjoy and get trapped in a loop of looking for more and more free money, free capital, because they do not have an objective view of their costs, and the value that is being created is not benchmarked on the real cost that they're actually experiencing. So they are sort of in a bubble. And when this grant capital is not available anymore, many of them, lose sight of how profitable or how viable their business is. So they focus on serving the funder rather than the customer. And how this affects the entrepreneurs, it blinds them and eventually kills these businesses. Entrepreneurs who build to solve problems and look primarily to create value will look for different forms of capital. They will utilize grants. Grants are not terrible. Grants are usually great when you're beginning, right? But then after that, they will look to create value for their investors, for their funders, but most importantly for their customers. So I think support is needed, technical support, knowledge, funding, right? Depending on the stage where the business is, like I mentioned, the right kind of financing. But entrepreneurs need to be very critical of what kind of financing and what that financing is doing to them and to their businesses. If it is not adding, value in the short or long term, if it is crippling them, if it is removing their attention from the customer, then there is a problem there. So for me, my advice to entrepreneurs is understand where your business is, understand what is the right type of capital you would want, understand if it is the best kind of capital that you need, utilize grants if they are there, especially at the early stage. Understand that, grant capital also can be a liability. Some investors actually resist and stay away from those they call grantpreneurs, something many entrepreneurs do not know, and focus on creating value.
Okay. That's good advice right there. So because we're relevant, and as impact investors working in Uganda, we try to combine capital with hands-on business and financial support. What difference does this integrated approach make, in your opinion?
So both of them, a blend of capital plus technical support, is our secret sauce to enabling entrepreneurs succeed. It is that they have the financial resources to invest in the critical areas, opportunities for growth, and they also get access to the knowledge, to the networks, and to the opportunities that they can leverage to grow their businesses. So if you're investing in the critical assets, in the working capital, and you're getting the connections to the markets, the connections to partners, then the business is growing holistically. And besides financing that is usually straightforward, you think about where to invest. When it comes to the technical assistance element, you're thinking about building the structures in which this financing and this growth will operate, right? Governance structures, we're talking about operating procedures and policies, building a board. So when other partners, when other financiers come on board, they see that this is a serious entity. You are building something for the long term, and they will be more attracted to working with you. So our objective is to create in Uganda what we call katogo of both financing but also of technical assistance, because both of these together are what will enable an entrepreneur, one, invest into what they think is critical, but then secondly, also utilize the knowledge to build their business for scale.
Okay, so we're slowly coming towards the end of this first podcast episode. As a closing sort of question, if you could change one thing about how small businesses are supported in Uganda, what would it be and why?
So when I hear that question, it sounds to me like an ecosystem question. There are very many players in the Ugandan and even across Africa, across the ecosystems. We have, the financiers, we have entrepreneurship support organizations, we have government. If all these entities could collaborate to build an ecosystem for entrepreneurs, that everyone does their work to their best and does it in an integrated way that will build on one another, that would be the best thing for the ecosystem. So speaking directly to small businesses, if I were to give them, some advice, for me it would be surround yourself with an ecosystem of partners, of organizations that support entrepreneurs, organizations like Relevant and many others in Uganda, so that you can access the critical resources, you can access the knowledge and the networks to grow. Because those that have been on the entrepreneurial journey can tell you it is a lonely journey. It is very, very difficult to succeed. And it requires that we embrace our African value of community to be able to leverage it and succeed. Because in the end, we start businesses, to make ourselves better, start businesses to make our families better, to make our communities better, to make our countries better, to make our continent better. So there's nothing better to me than doing things together. So surround yourself with an ecosystem, go to that event, meet that partner, and let's create those critical bonds and relationships to uplift the ecosystem by tapping into the different value propositions.
That was an amazing closing remark. Thank you so much, Edson. And thank you for those insights. I took away a lot from your answers, and I hope our listeners did too. Thank you for spending those few minutes with us, and we will find you again in the next episode.